Hello everyone and welcome back to the sessions on fixed income for CFA Level 1. Now, in the earlier chapter, Securitization, and in earlier classes, we have already learnt a brief about what are asset-backed securities and what are mortgage-backed securities. In your fixed income curriculum, the last couple of chapters are complete chapters focusing on ABS, that is this one, and the next one which we are going to learn, that will be MBS, mortgage backed securities. So it was essential to understand the whole process of securitization before we get into this particular aspect. So this is something very interesting, and even though theoretical mainly, but still it is quite interesting, and let's dive into the subject directly. So we have a bit idea of what are asset-backed securities. So asset-backed securities are financial instruments. So they are primarily financial instruments backed by a pool of underlying assets. These assets typically generate regular cash flows such as auto loans, credit card receivables, student loans, equipment leases, and so on. Now, if I include mortgage loan over here, it will become mortgage backed securities. So we are keeping mortgage loans aside. So asset backed securities, because even mortgage properties are assets, so you may still call it asset backed security or an asset pool, but here we are considering all assets other than mortgage loans. Now, why these components are considered as assets, and what is the significance of this asset backing? What are asset backed securities? Let us try to understand the clear meaning of asset backed securities. So within asset backed securities, you can say these are financial instruments which have backing of an asset pool. Now, which kind of asset pool? These asset pools are themselves financial assets. Now, what do we understand by financial assets? Say it typically represents the right to receive cash. So let us take an example. Say there is a finance company which has given auto loans, or which has given some working capital loan to different entities, and these loans which have been given by finance company that have a defined structure of repayment. Certain loans are bullet loans where only the interest component will be paid, and at the end the lump sum maturity value will be the given back to the finance company, that is the par value. On the other side, certain loans can be structured on EMI basis or EAI basis, what we call as equated monthly installments or equated annual installments, so that there is a regular cash flow which includes both components, the interest and the principal repayment. So when this finance company has given these loans, it now has a responsibility to collect it, and it also has a right to receive it. That right to receive cash flow or right to receive cash becomes a financial asset in the hands of the finance company. Now, as we have seen in the process of securitization, that this right to receive these cash flows, this is not having immediate liquidity, and therefore the pool of these assets is regarded as a kind of illiquid asset pool. Now, because this is illiquid asset pool, and finance company to carry on its business, it needs to have funding. So what these finance companies do, they sell their asset pool. That means what they have as right to receive the cash flow from the customers, that right to receive that cash flow is transferred to another entity, what we generally refer to as SPE, that is special purpose entity, or SPV, special purpose vehicle. These entities, they act as agents of the finance company, but they have actually bought these receivables or these loan receivables from that finance company. This SPE is going to issue securities in the form of bonds These securities will be fixed income securities or bonds, but they will have the backing of this asset pool. Now, the moment someone is issuing bonds, the investor will have the first question as what will be the source of repayment, because when you are investing your money into bond, you should first look into the safety matter. That is your money safe? If there is risk, what is the degree of risk? What will be the source of repayment? So this SPE that is issuing these securities has got these securities rated by a credit rating agency. You know, we have learned all this in the process of securitization. Now, what happens is these securities are having backing of that asset pool. So what does that mean? The investor for these securities will be given assurance that, see, your money is safe with us, because when we have an asset pool, we will have some customers who are going to pay back their loans and interest thereon. That money we are going to utilize to pay you. So this is called what we identify as backing of asset pool, and therefore the securities issued by this SPE are titled as Asset-Backed Securities, ABS. So they have the backing of this asset pool. Now what happens between the finance company and this SPE, that from the balance sheet of the finance company, all these assets are removed because these assets are transferred to the SPE. It is now SPE that will control these assets and not the original finance company, which in the process of securitization is referred to as originator. So originator will not have any role to play in terms of these assets. So this is what we call as off balance sheet adjustment, means it will go out of the balance sheet of the originator and it will be the asset controlled by the SPE. Now, what we are trying to now learn is knowing what is asset-backed securities. Of course, we are going to discuss asset-backed securities also over here, but the new point that we are going to learn mainly is the concept of covered bonds. This concept of covered bonds is something new for you. So asset-backed securities you have learnt. This is just giving you a little brief, kind of revision of what is asset-backed securities and going also a little deeper into different features and attributes of that, and covering special aspects as well. But the initial part of our discussion is mainly linked with comparison between asset-backed securities and covered bonds. So what I will do for you is, let me first go through the meaning of asset-backed securities once again. So after this discussion that I had with you, if we read these lines, asset-backed securities are financial instruments backed by a pool of underlying assets. These assets typically generate regular cash flows such as auto loans, credit card receivables, students loan, equipment leases. All these are financial assets and they will generate regular cash flows. The issuer, usually a bank or finance company, sells the pool of assets to a separate legal entity called special purpose entity. I have already explained that to you. The SPE issues bonds that are asset-backed securities to the investors and uses the cash collected to buy the asset. So SPE has bought these asset pool from the finance company. This SPE now has to pay back to the finance company, and from where will it get money? When it is issuing these asset-backed securities to the investors, investors are going to provide cash to the SPE, and SPE is going to use that cash to pay off the finance company against the purchase of these asset pool. So this is basically the process that you have by far understood. So SPE issues bonds, that is ABS, to the investors and uses the cash collected to buy the assets. The cash flows from these assets, like EMI payments, are then used to pay interest and principal to ABS investors. That is why we call this as asset-backed securities. So when you are collecting the money from your loan repayments and interest thereon, that money will be used for making coupon payments and principal repayments for the asset-backed securities that are issued. In an ABS, the pool of assets is separated from the issuer and legally owned by the SPE. I have already talked about that. Now suppose a bank has rupees 100 crore worth of car loans. If the bank wants to convert these into asset-backed securities, it cannot keep the loan on its books. So the bank sells these loans to newly created legal entity called a special purpose entity. Once these assets are sold, the SPE now becomes the legal owner of the car loans. This means the issuer, that is bank, no longer owns or controls these loans. The loans are separated from bank's balance sheet. Even if the bank later gets bankrupt, these assets are safe inside SPE, protected for the benefit of investors. ABS investors are not exposed to the credit risk of the issuing bank. They are only concerned about whether EMIs from the borrowers will be received. So this is to be clearly understood that this is the whole arrangement of ABS. I would want you to just quickly have a reading of this last paragraph over here, this particular paragraph. I'll give you a minute, quickly read it. So why did I ask you to read this once again? I will just go little deeper into this aspect. See, the finance company has given loans to its customers. It could be auto loans, it could be credit card loans, whatever. That finance company has now the right to receive their principal and interest thereon. So it is their right which is lying as asset in their balance sheet. In the process of securitization, this entire asset pool is transferred to the SPE. So you understand one thing, that asset pool, because it is now separated from that bank or finance company, and then on the backing of that asset pool, it is SPE that is issuing securities. So you please understand, one side we have, look into this, one side we have say the finance company, the originator, then we have SPE, and then we have ABS investors. Finance company has given its asset pool. That asset pool is transferred to whom? The SPE. So now ABS investors are investing in the securities issued by SPE based on this asset pool, that is at the backing of this asset pool, correct? On this particular trust, on this trust that is at the backing of this asset pool, they are confidently investing to buy the securities issued by SPE. Now imagine something goes wrong with this finance company, it gets bankrupt. Our ABS investors have no trouble with that because they are not linked with that at all. These asset pools are now belonging to the SPE. So it is the whole relationship between three things: the SPE, which is issuing the asset-backed securities, the ABS investors who are buying these securities and the asset pool which is at the backing, which is a kind of assurance that there is a source of repayment available with us. So ABS investors are more concerned with this asset pool rather than the position of this finance company. Nothing, now the finance company is out of picture. The moment this asset pool is sold and ABS are issued, finance company is out of picture. That is why even if that goes bankrupt, it is not going to affect our ABS investors. That is what explained over here in this paragraph. Once the assets are sold, SPE now becomes a legal owner of the car loans. This means issuer or bank no longer owns or control these loans. The loans are separated from the bank's balance sheet. Even if the bank later gets bankrupt, these assets are safe inside the SPE, protected for the benefits of the investors. So ABS investors are not exposed to the credit risk of the issuing bank. I am sure you understood this line now, that whatever be the credit risk of this finance company, ABS investors have no linkage with that. They are only concerned about whether EMIs from the borrowers will be received. They are mainly concerned with this asset pool. Now, that was all about APS, that is asset-backed securities. I am now going to bring the new point of discussion, and this is something that you haven't learned earlier, what we call as covered bonds. Now, covered bonds are also having security features similar to ABS, that there will be an asset pool that will be at the backing of these securities, but we don't call this as ABS. We rather call these as covered bonds. Now, what happens in covered bonds? If I just continue with that same example earlier, the finance company which was giving car loans, it has created a pool of assets for itself which is in its balance sheet, and now it wants more liquidity. This time, instead of these asset pool being transferred to SPE and SPE issuing the bonds, our finance company itself will issue bonds at the backing of this asset pool. That means the asset pool does not leave the balance sheet of the finance company. Asset pool stays with the finance company. That means finance company continues to have the right to receive the cash flows from that asset pool. It is not transferring this right to anyone, and therefore it itself is issuing bonds where the backing is still for this asset pool. That is, this asset pool is still at the backing, but the asset pool is not transferred to another entity which is special purpose entity. So there is no SPE coming into picture at all. So now there are three parties involved over here. If I can say, there would be which three parties involved? There will be borrowers which are actually creating the asset pool, and this asset pool is the asset of that finance company. No SPE is coming into picture. Finance company is issuing bonds to whom? To investors. Finance company is issuing bonds to investors. So there is no SPE into picture. This asset pool continues to remain in the balance sheet of finance company. Balance sheet of finance company will continue to have these asset pools. Just the backing is of these asset pool for the bonds which are issued. So these bonds, they have the backing of this asset pool. I am sure you are able to understand the connect between the covered bond concept and how it is different from ABS. So one biggest difference between ABS and covered bonds is what? Rather, if I first talk about similarity, they both have backing of an asset pool. That is a similarity. But what is the difference? A special purpose entity is appointed in the case of securitization process where ABS comes into picture. On the other side, when it is covered bonds, the finance company itself is issuing the bonds at the backing of these assets in the asset pool. So let us read something about these covered bonds, and let me enhance the screen size for you. Covered bonds are similar to ABS in that they are also backed by a pool of assets. However, there are important differences in the structure and risk. The cover pool of assets remain on issuer's balance sheet. I already explained to you, there is no SPE involved. The bondholders have a dual course. They can claim from both the cover pool and the issuer's other unpledged assets in case of default. Now, this is yet another major difference between the asset-backed securities and covered bonds. In asset-backed securities, the only safety measure was the asset pool, because SPE has issued bonds at the backing of these asset pools only. It has no other source of repayment of these bonds. On the other side, when the finance company, in case of covered bonds, it itself issues bonds at the backing of these assets which are forming that asset pool. In case some defaults arise and asset pool does not stand enough to repay the bonds on maturity or make the payments to the bondholders or investors of covered bond, then other assets of this finance company are also to be dragged for repayment of this liability. In other words, the other assets which are unpledged to other entities or any other security can be utilized for repayment. Means there is a dual course or dual recourse. You know what is the meaning of recourse? We say that if the payment does not happen from this particular source, we will have another course of action, we will have another source of payment that can come into picture. That is what we call as recourse. When I say dual recourse, we have a clear two different sources of this repayment. One is the asset pool itself, and another those all unpledged assets of the finance company which are not committed to any other entity. So in our discussion ahead, we will say, now suppose a bank has rupees 100 crore worth of car loans. If the bank wants to convert these into covered bonds, bank does not sell the loans. The rupees 100 crore of car loan is put into a cover pool which is kept aside but still remains on the bank's balance sheet. Bank directly issues covered bonds to the investors. SPE is not involved over here. So bank creates a special box inside itself called covered pool and puts high quality loans like mortgages into it, but the ownership of these loans doesn't leave the bank. Bank sells covered bonds to investors. These are bonds backed by the cover pool. So who guarantees the repayment? The bank itself and the asset in the cover pool, and that is why it is called a dual recourse. If something goes wrong, investors can claim from the cover pool and mortgages and also claim from the unpledged assets of the bank, that is part of the bank not already promised to other lenders. This is a huge safety advantage compared to ABS. To protect investors even more, loans in the cover pool must have low loan to value ratios. Now what is this low loan to value ratios? The loans in the cover pool must have low loan to value ratio. Loan to value. So value which is at the backing, suppose that is say $100, then the amount of loan is only $90. That gives you some additional support that okay, our liability is lower than the backing of the asset. That means whatever be the risk, the asset backing is more than the amount of that liability, and that helps to bring down the risk of the investors ultimately. The cover pool is usually larger in value than the bond amount. This is called over collateralization. So we are going to talk about over collateralization in detail, but collateralization, that something is given as a collateral. Over collateralization means you have something as a much safer measure compared to generally what we call as collateralization. So we refer this concept as over collateralization. An independent party checks and monitors this regularly. If any loan in the pool goes bad or gets prepaid, the bank must replace it. So the cover pool is always healthy and sufficient. Now this is a beautiful concept in itself. Like say this is the asset pool. One of the borrower in this asset pool made a default. That means there is something wrong with the asset pool. What bank will do? It will remove this borrower from this asset pool and bring a new borrower over here. And it will deal with that defaulting borrower separately. So the asset pool doesn't get disturbed. This was not possible in case of ABS because asset pool was lying with SPE. Here asset pool is lying with the bank. It is just keeping it separated just to provide the backing to the covered bonds. Correct? So another example. Suppose one particular borrower wants to make prepayment and clear off their loans. That means that money is already received, right? But we want this asset pool because suppose we have issued bonds with a maturity of 10 years. We don't want immediate cash flow. We want only that much money which is enough to make coupon payments. It is only after 10 years we want to repay the principal or we want to repay the par value. Until then we are just interested in receiving enough cash flows in the pool to pay off the coupon payments only. So if a borrower or few borrowers are making prepayments, what will we do with that money? So what the bank does or that finance company, what it does, it immediately removes such prepaid loans from the asset pool and introduces new loans in this asset pool so that the value of the asset pool remains constant. And I would say not just the value, even the quality of the asset pool remains constant. This increases the trust and faith of the bond investors in the issuing company. So moving ahead, I would show some differences over here, and what you can do, you can, if required, you can pause the video and take the screenshot, or you may pause the video and write it, whatever is convenient for you. Alright friends, I believe you would have taken the screenshot or you have written the whole content as I have instructed. Now let us talk about the differences one by one. And here we start with the first point of difference in terms of feature. We would say legal structure. For asset-backed securities, it involves an SPE, there is a special purpose entity gets involved. And in case of covered bond, no SPE, issuer retains the ownership. So I believe this particular difference is clear to you. Asset ownership. Assets are legally transferred to SPE. Asset remains on the issuer's balance sheet. I am sure even this point is clear to you. Recourse. For asset-backed securities, investors have a recourse only to the SPE. That means they cannot have anything else to be recovered from. On the other side, the concept of covered bond, the recourse will be a dual recourse. Investors have dual recourse, that is covered pool plus issuers unencumbered assets. What is the meaning of unencumbered assets? Assets that are not pledged on any other liability or to any other entity. Capital relief, a very important point. Issuer typically gets regulatory capital relief. And here issuer does not get the capital relief. Now this point you need to understand very well. I'll explain it to you. Please understand. See, all banks and finance companies, they are required to maintain capital adequacy ratios. They should have enough capital. So when they are having assets which are receivables, these are called risky weighted assets, because there is always a risk. It is your asset, understood, but there is risk that what if people don't pay you money. So this risk, risky assets, if you are removing from your balance sheet, it is giving you a relief that you are having adequate capital and you don't have this kind of risky assets. In fact, when in case of ABS, when the finance company is selling that asset pool, in exchange it is getting cash, right? Now you tell me, what is more secured asset, cash or that loan receivable? Loan receivable is always risky. Cash already in hand cannot be considered risky. That is the major difference, correct? So in case of matter regarding capital relief, issuer of ABS, they get regulatory capital relief, their capital adequacy ratios get better. But in case of covered bonds, issuer does not get capital relief since assets remain on balance sheet. Which assets we are talking about? The loan receivables, which are classified as risky assets for the finance company. In this case, because it is getting out of the balance sheet, so from your balance sheet that is removed and what is coming in is cash. So in case of covered bonds, what is happening? You are getting cash, but what is happening? Against that cash you are issuing covered bonds. That asset pool, which is your asset, is still lying in your balance sheet, which is a risky asset. So against the new cash received, you have issued new bonds. That is having a direct nexus between them, but the risk which was there in this asset pool continues to stay with the finance company or bank. Credit tranching, commonly structured with multiple tranches, usually not structured with tranches. We have seen in the process of securitization that you make various tranches depending upon the credit quality of that particular security. So you make different tranches of security, as in what is the credit quality of each. So you may have that tranching happening in case of asset-backed securities. Those tranches are not classified in covered bonds because all covered bonds are resembling the same type. Asset pool is static, it is fixed at issuance, and in case of covered pool, that is covered bonds, all your asset pool remain dynamic. I have already explained it to you some time back, that I have given you a couple of examples, that what if in a scenario that the borrower is making a default or the borrower is making early payment or prepayment of their loans, then these assets are removed from the asset pool and new assets are brought in this asset pool. That is why in case of ABS it is static, in case of covered bonds it is dynamic. Now investor risk. In case of ABS, the investor risk is higher because no dual recourse is there. In case of covered bond, the risk of the investor is lower because of the presence of dual recourse and over collateralization. Anyway, we are going to talk in detail about dual recourse and over collateralization, but once again, just in case if you haven't taken the noting of this, I'll put it once again on the screen. Alright friends, now it is time for us to move ahead and let us discuss this point. Covered bonds are senior debt obligations issued by financial institutions. They share similarities with traditional asset-backed securities but differ fundamentally in their legal structure and balance sheet treatment. So basically the most important point in this paragraph is that these are treated as a senior debt. You may underline the term senior debt. And second thing, they differ fundamentally from ABS, that is what we have already discussed. So why it is treated as a senior debt? Let me explain this point. If you have seen right from the beginning of the fixed income subject, right from the first chapter where we have started learning the fixed income instruments and features, we have been talking about the seniority. So these covered bonds, they become most senior because they have dual recourse, because it's a completely secured kind of asset or a completely secured kind of investment from the viewpoint of investor. As a result, these are treated as senior debt, and the later part in this note is about the dual recourse protection, which we have actually discussed already. Let us read it out. Dual recourse protection. In case of issuer default, covered bondholders enjoy dual recourse, which means primary recourse to cover pool of assets backing the bond, and secondary recourse to the issuer's other unencumbered assets, that is assets not pledged as collateral for other debts. So we already understand what is dual recourse protection. Now moving further, this enhances investors' protection, unlike in a typical ABS structure where investors can only claim against the SPE asset. To reduce the risk for investors, the value of cover pool is usually greater than the bonds issued. This is called over collateralization. The quality of pool is regularly monitored by a third party. The issuer must replace bad or prepaid loans in the pool to maintain the promised payments. Each of these points we have discussed earlier, so nothing new. Key features of covered bond. Number one, on balance sheet treatment. So they are not off balance sheet treatment, they are on balance sheet treatment. No special purpose entity getting involved, and then it is about the issuer profile. So let us read out these content. The first point, on balance sheet treatment. The asset backing the covered bonds, known as the cover pool, are segregated but remain on the balance sheet of the issuing institution. This contrasts with the standard ABSs, where the underlying assets are transferred to a special purpose entity, thus removing them from the issuer's balance sheet. So here the second feature is no special purpose entity involved. Covered bonds do not involve an SPE. Hence, the originator remains responsible for managing the asset pool and the bond obligations. Issuer profile. Covered bonds are primarily issued by banks in Europe, Asia and Australia. The cover pool generally consists of mortgage loans, though other asset types may also be included. When the issuer of a covered bond defaults, the way payments are handled can vary depending on the type of the covered bond. These structures are designed to balance investor protection and market stability. And there are three primary types of such covered bonds, which are based on their maturity and handling mechanism, and these are referred to as hard bullet covered bonds, soft bullet covered bonds, and number three, conditional pass through covered bonds. So I believe what we have seen in the earlier part about the key features, I don't think I have any need to explain any of these points further. Correct? Now, what I want to mainly discuss are the types of covered bonds, classified into three fundamental categories: hard bullet covered bond, soft bullet covered bond, and conditional pass-through covered bonds. All are covered bonds, but they vary in their types. Now, you can say hard bullet covered bond, it is the most strict category. If there is any default made by the bond issuer, immediately the whole bond will be demanding the payoff of the entire principal outstanding. In other words, the bonds will be cancelled on immediate basis if there is even a single default made by the bond issuer. So if I am the bond issuer and if the bond is a covered bond, and this category of bond, that is hard bullet covered bond, even if I make any default in a coupon payment, the entire bond will have to be repaid instantly, immediately. That is what we call this as hard bullet covered bonds. On the other side, if it is soft bullet covered bond, and suppose there is a default made in the coupon payment, the bond feature will allow the issuer of the bond some extended period for the making of payment. That means some breather, some relaxation is given. forget about coupon payments. Even if the principal repayment which is to be done at maturity, if that doesn't happen on the due date, then maybe a year of additional relaxing period can be given to the issuer of the bond. Means the issuer gets a little more relaxed. Of course, there may be some additional payments that may arise depending upon the arrangement between the investor and the issuer. But hard bullet covered bonds contain very, very stringent and strict provisions, whereas soft bullet covered bonds are little softer on the issuer, means giving little more relaxation kind of approach. So between these two also, if you compare from the investor's viewpoint, hard bullet covered bonds are little less risky because it is going to be a big trouble for the issuer if the issuer is making any default. Third category is conditional pass-through covered bonds. First of all, let us understand what is the meaning of pass-through. The moment I say pass-through, suppose there is an asset pool and I say as and when the money comes in that asset pool, the issuer of the bond, that is me in this case, I will not utilize a single penny out of that. The entire proceeds from the asset pool, what is collected, will be simply utilized to pay off the bondholder's right. Pass through means whatever is coming from that asset pool, I am passing it to the investors. I am not going to hold it at all. I am not going to utilize a penny of that cash flow. This is the meaning of pass through. So these are conditional pass-through covered bonds. Now what is the exact meaning of this conditional? Originally these were bullet bonds, means they were supposed to make coupon payments and on the maturity the par value was to be repaid to the investors. That was the primary structure. But in case there is a default, immediately it is converted into what we call as pass-through covered bond, means then it will become pass-through. That means the first right of that asset pool is now not even with the issuer of the bond but with the investors. That means you will have to transform these bonds into covered bonds. This actually gives a kind of relaxation even to the investors. They are finding this bond as quite safe to invest, and the issuer will be losing control over these assets if there is any default made. So hard bullet covered bond, one category, soft bullet covered bond, another category, and conditional pass-through covered bond, the third category. So let us do one thing. Let us read about these three bond categories in detail. So if we go into the details, we would say hard bullet covered bonds. These are the most rigid in terms of structure. If the issuer fails to make a scheduled payment, the bond is considered immediately in default. This leads to acceleration of payments. What is the meaning of acceleration of payments? You should be very clear with that. Suppose the bond due date, or say the bond tenor, is remaining 7 years, but at the year end when there was a coupon payment supposed to be made and the issuer makes a default in that coupon payment, acceleration means the entire, now you cannot wait for 7 years, the entire bond's value stands payable immediately. That means it becomes due immediately, fully, including the principal repayment. So that is the meaning of this acceleration, and which is an important attribute of hard bullet covered bonds. The entire outstanding principal becomes due immediately. The cover pool may be liquidated or managed to meet these demands swiftly. So if you find that cover pool was the backing, you liquidate the cover pool immediately, maybe by selling it to the other party, and with the proceeds you need to repay these bonds. That kind of stringent conditions you will be finding with hard bullet covered bonds. What happens to soft bullet covered bonds? These are more forgiving than hard bullet bonds. If a scheduled payment is missed, the maturity date may be postponed, usually by up to 1 year. This delay is designed to provide time for asset recovery, avoid immediate default and acceleration, give issuer or cover pool manager time to work things out. The third category is the conditional pass-through covered bonds. These are a hybrid structure. It behaves like a bullet bond until maturity. But if issuer fails to pay on time, it switches gears and pays like a pass-through bond. If the issuer cannot pay by the original maturity date, the bond automatically converts into a pass-through security. Investors will receive cash flows only as and when payments are received from the cover pool assets. No fixed maturity anymore depends on loan performance in the pool. So one very important feature of this covered bonds which fall into conditional pass-through covered bond category, in case any default is made and the bond gets transformed into the pass-through category, what happens then? There is no fixed maturity because it is passed through. When the cash will be collected, that is the time when the repayments will be made to the investor. So there is no fixed or determined maturity and cash flow. On the other side, in case of hard bullet, what we have seen, you will be making the entire payment immediately, and what we have seen in soft bullet, if there is a default, you give some relaxation, you give some time, maybe by charging some additional penalty also, but you give them some time, and over a period of extension maybe the issuer should be able to pay off the bond. That is the structure. So you can understand the difference between these three. Alright, then if these things are clear, let us move ahead and we now talk about next category of our discussion, that is credit enhancement structures used in securitization. In the securitization structure, credit risk arises when borrowers in the collateral pool defaults on their payments. To protect investors in the ABS from these losses, the structure often includes built-in protections known as internal credit enhancements. These mechanisms that absorb losses before they can impact the most senior bondholders. So which different form of protections can be given? The form of internal credit enhancement, number 1 comes over collateralization, number 2 is excess spread, and number 3 subordination or credit tranching. Let us first talk about over collateralization. The total value of the asset pool is greater than the total face value of the ABS issued. It provides cushion against default. Some losses can occur before investors are affected. It provides first loss protection to all tranches of the ABS. So one good feature about over collateralization, even if you have made tranches of your ABS, the moment there will be some default, because the value of the asset pool is much larger than the face value of the securities issued, what will happen? Whether you have made tranches or not, what will happen is all the tranches get the first layer protection because of over collateralization. Means everyone stays protected. Let us take this example. If collateral equals to $600 million and ABS issued is $500 million, then over collateralization is by $100 million. So this much value against the total collateral value. So 16.7% of the asset pool can default before investors see any. So why you have computed this percentage? This percentage is basically $100 million, how it stands to $600 million. So 100 by 600 will give you 16.67%. That means to that much asset deterioration or the asset pool deterioration, the bond investors are still protected. They are not going to lose at all. It's a kind of margin of safety. That much loss is tolerable. That is the benefit of over collateralization. And even when you have made different tranches, say senior, mezzanine or junior or equity, all these tranches will be handled in the same way because of over collateralization. All of these tranches are getting equal degree of protection. Now, the other thing is excess spread. This is the other mode of providing that additional protection. The difference between the income generated by the collateral pool and the interest to be paid to investors. Now, if you can see, the first aspect, over collateralization, mainly targets the principal, and the excess spread is mainly targeting the coupon payments. So look at this, the difference between the income generated by the collateral pool. So whatever be the regular ongoing recurring income generated by the asset pool and the coupon payment to be made on the ABS, that is ABS to be paid to the investors, you always try to make a positive differential. So the income is greater than the interest paid to the ABS investors. That means when you are talking about principal, you mention this as over collateralization. Same concept when you are linking with the coupon payments, you don't call it over collateralization, but you call it excess spread. That means this is protecting the coupon payments, whereas over collateralization is protecting the principal payments. This extra income spread accumulates in a reserve account and can be used to absorb credit losses or temporary shortfalls. Acts like an earnings buffer. So it is an earnings buffer providing internal protection without needing external support. So collateral earns 9% and ABS coupons paid is 6%. That difference of 9 minus 6, that 3% excess spread annually, which is held in the structure. This is going to be accumulated in a reserve whenever utilized. That means when there is a shortfall, when say you are not able to recover enough income to pay the coupon payments, that time you can draw back from this reserve what you have created annually. So this approach is mainly used to protect the coupon payments, whereas over collateralization was mainly used for protecting the principal repayment. I am sure you are clear with the first two categories. And now, subordination or credit tranching. ABS structure is divided into multiple tranches, each with a different seniority in cash flow priority. So if you can recollect what we have learned in the waterfall structure of ABS initially. Waterfall structure of ABS means you are trying to identify the most senior to the most junior debt in the tranches. So most senior and the most subordinate, or you can call it most subordinate or most junior. In that order you are going to make the priority of payment. That means if some default happens, it is the subordinate category that will suffer and the senior category will not suffer. The loss gets absorbed first by the subordinate category, which is the most subordinate, and then the lesser subordinate, then further lesser subordinate, and all the other senior categories. So depends on how many tranches you have made. Tranches are basically categorization of your bonds or of your ABS, and that is where the topmost tranche, which is the most senior, is the top quality security having lowest risk. Now one fundamental thing is clear: the lower the risk, the lower will be the coupon rate also, because when you are asking the bond investor not to take too much risk, you are not going to compensate them by providing high yield. But if you are asking some investor to take the risk, they would want a higher yield. So basically you have offered, by making tranches, you have offered to all categories of investors. Someone who wants to take lowest risk will earn lower coupon payment or will earn lower yield. Someone who is willing to take high risk will be earning high yield. That is the basic criteria. But because of these tranches, understand one thing, you are being little biased, that whoever is the senior category will be protected but junior category is at risk. So you are being biased among the tranches, whereas the earlier matters what we have discussed, over collateralization, it protects or it provides protection to all the tranches, treating as if everything is fine. It is this subordination feature that makes little biasness among the different category. So it is up to the investor which category of bond you want to buy. If there are defaults, losses first impact the junior tranches. Senior investors feel more secure and can get higher credit ratings and lower required returns. Let us take an example over here. Say total ABS is $100 million, senior is 70 million, mezzanine is 20 million, junior is $10 million. So this is how you have total ABS value into these three tranches. The senior tranche is protected by 30 million, means imagine that out of 100 million, if there is a 30 million loss in the subordination approach, 30 million loss will be borne by the junior first, then the mezzanine. No loss will come to the senior category, correct? So 30 million is the protection, that is tranche protection for the senior. Now let us take a little detailed example over here, and let me enhance the screen size for your proper reference. Let's look at an example to illustrate how a senior or subordinated structure redistributes the credit risk compared to a single class structure. So consider an ABS with the following bond classes: tranche name, tranche A, tranche B, tranche C. So these are senior notes, these are subordinated notes, and these are also subordinated notes. The face value, you have $300 million, $80 million, $30 million, aggregating to $410 million. Interest rate is MRR plus 0.5%. This is also MRR plus 1.5%, and the third tranche, the interest rate is going to be completely variable. Tranche C is the first to absorb any losses. That means tranche C is the most junior note. Now, because it is the most junior tranche, until losses exceed $30 million in principal, being the lowest ranking tranche, it has a residual claim to any leftover after other more senior tranches have been paid. And for this reason, it is often referred to as the equity tranche. Now, the term equity represents the ownership, right? But in case of subordination, the most subordinated kind of bond in this category, which is tranche C, is generally referred to as equity tranche. So it is not equity, it is a fixed income security, but it is following the nature of equity because at the end whatever is left over will be given to them. Any losses from default of the underlying asset greater than $30 million and up to $110 million will be absorbed by subordinated tranche B. So if the losses are up to $30 million, it is only C that gets affected. If the losses exceed $30 million, but the losses are to the aggregate of these two, that is 80 plus 30, $110 million, then and then only subordinate B, that is tranche B subordinate notes will get affected. Senior notes, that is tranche A, will get affected only after this entire loss has been absorbed by these two tranches. That means when the loss exceeds $110 million. Now, up to $110 million loss, tranche A will not contribute anything to that loss. The senior tranche A is protected from any credit losses of $110 million or less, and therefore will have the highest credit rating and offer lowest yield of the three bond classes. It is through this credit tranching and the bankruptcy remote nature of SPE that senior tranches of ABS can receive credit ratings higher than of the originating company that sells the collateral of the SPE. This structure is also called a waterfall structure because in liquidation, each subordinated tranche would receive only the overflow from the more senior tranches if they are repaid their principal value in full. As long as a tranche remains outstanding, it will receive its coupon payment. For example, say an investor purchases $10 million face value of the tranche B notes. If MRR is 4% and if there are no defaults in the underlying collateral, the investor will receive an annual coupon of $10 million into 0.04, that is 4% plus the spread that was 1.5%, on absolute basis it is 0.015. So it is 0.04 plus 0.015 will make it 0.055. So basically 5.5% of $10 million, which will be $550,000. If the defaults in collateral pool amount to $50 million, the first $30 million of loss will be allocated to tranche C, while the remaining loss of $20 million will reduce the outstanding face value of the tranche B note from $80 million to $60 million. So understand this point very well. This is something crucial. We are assuming that the total loss in the collateral pool is $50 million. Now if we know that $50 million is the total amount of loss, if I get back to that table, look at this table, who is going to absorb $50 million loss? $30 million loss will be absorbed by tranche C, and then the remaining loss of $20 million will pull down the face value of these subordinated notes, which is basically tranche B, and nothing will come to tranche A. Tranche A remains as it is. This 80 will become 60 because $20 million loss getting absorbed by tranche B, and this $30 million comes to zero value. So what will be the impact of reduction in the face value? The impact will be observed over here. Look at this. If the defaults in the collateral pool amount to $50 million, the first $30 million of losses will be allocated to tranche C, while the remaining loss of $20 million will reduce the outstanding face value of tranche B note from $80 million to $60 million. The coupon earned by investor in tranche B notes in this case will be, see, $550,000 was the defined coupon payment provided everything goes fine, but this is based on the par value of $80 million. What will happen if that par value changes from $80 million to $60 million? Proportionately, $550,000 coupon payment will be adjusted by the ratio of 60 by 80, which comes to $412,500. So what is the coupon payment that you are going to make in case of losses in the asset pool? Not just the principal, but even the coupon payments will be getting affected. That is what this example is trying to convey. I'll just show that working in detail over here for your reference. Alright guys, if this part is clear to you, let us now move on to non-mortgage asset-backed securities. Now here something very, very important. See, when we call something as asset-backed securities, with the general terminology, asset-backed securities can be having asset pools which include mortgage loans or asset pools that do not include mortgage loans. So typically asset pools which are having mortgage loans, so there is an asset pool which is comprising only of mortgage loans, then it is typically a mortgage pool, and if that becomes the backing of any security, it will rather be referred to as mortgage backed securities, correct? MBS, which is a different topic of our discussion ahead. When we simply talk about ABS as a general category, it may include an asset pool which is mixture of mortgage loans and non-mortgage loans. Mortgage loans are maybe secured category, non-mortgage could be little unsecured or partly secured. So here our focus point is a pool of assets which is typically non-mortgage pool. That means it is non-mortgage assets, yet in other words I would say mortgage loans are not included in that asset pool at all. So while many ABS structures are backed by mortgage loans, there is a broad and growing universe of ABS that are backed by non-mortgage financial assets. These include business loans, auto loans, credit card receivables, accounts receivable, even non-traditional assets like music royalties. Now if you can see, even owner of a copyright which can bring music royalty income, even that becomes an asset pool or an asset which is having cash generating capacity. So any asset that can have defined amount of cash flow that can be generated can become an underlying asset in an asset pool, as simple as that. So it may include even intangible assets like copyrights and royalty rights, correct? So any asset generating predictable cash flows, the idea is it should be able to generate the predictable cash flows, can theoretically be securitized because it is getting or becoming part of an asset pool which is non-mortgage assets. So I am sure you are able to understand the two categories, mortgage pool and non-mortgage pool. So purely speaking, if it is asset-backed securities, we generally perceive that as a broad category which partially may have inclusion of the mortgage loans as well within that asset pool. But if we are very peculiar about non-mortgage asset pool, that means that pool of assets is including all types of financial assets other than mortgage loans. Now we have amortizing versus non-amortizing collateral. So sometimes what happens, your collateral does not follow an amortization pattern. The best example could be a credit card receivable. So a finance company is having a credit card receivable. That amount is generally not amortized over a period. It has a definite life cycle, and or rather I won't say life cycle but a credit cycle, and on expiry of that credit cycle it becomes due, and the credit card user, that is the borrower, fundamentally who is the borrower, will have to make the payment. Or in case the credit card user is opting for a delayed payment and promising the interest payments to be made, then it again becomes a non-amortized category because principal repayment is not happening over a period. Principal repayment is happening at the wish of the borrower. On the other side, some others may follow amortization pattern where every payment made say on monthly basis will include interest as well as some portion of principal repayment. So amortizing loans, principal is repaid gradually over the time. That will include auto loans, mortgage and solar loans. Non-amortizing loans, no fixed repayment schedule for the principal borrower. That borrower repays the principal at their discretion, and the best example could be the credit card debt. This difference affects the cash flow structuring, risk and investor exceptions, and that is why two important categories we are going to discuss in detail, that is about the credit card ABS and the solar ABS. But before we start, I would want you to focus on this particular note about amortizing and non-amortizing loans. Alright, so the next matter to be discussed is with respect to credit card ABS structure and features. Some ABS structures are backed by credit card receivables, that is the outstanding balance that people owe to banks, retailers or travel card issuers. These receivables become the collateral pool for securitization. What makes these loans unique is that they are non-amortizing. There is no fixed schedule for repaying the principal. Borrowers pay principal whenever they choose, unlike a car loan or a mortgage where there is a fixed EMI schedule. The cash flows from these credit card pools come from interest, that is finance charges charged to cardholders, fees such as late payment or annual membership charges, any principal payments that borrowers voluntarily make. Because the borrower controls when to repay the principal, credit card ABSs are structured in two phases, a lockout period followed by an amortization period. So during the lockout period, also called the revolving period, the investors who bought the ABS will only receive interest and fee income earned from the credit card users. If any credit card holder repays a part of their principal, that is pays back some of what they owe, that money is not returned to the investors yet. Instead, it is used to issue new credit card loans so that the total loan pool remains about the same size throughout this period. Further given, once the lockout period is over, the ABS enters the amortization phase. In this phase, whatever principal repayments come in the form of borrowers are now passed on to investors along with interest. In other words, this is when investors start getting their money back in addition to returns. There is also a special safety feature called the early amortization provision, also known as rapid amortization. This acts like an emergency switch in case things go wrong. If the quality of the credit card loan pool starts falling, like if too many people stop paying their bills on time, this provision gets triggered. Once that happens, the ABS starts returning the principal back to the investors faster than planned to protect them from further losses. It acts like an emergency brake to minimize damage in a deteriorating credit environment. Alright, now whatever I have read, it's like easily understandable, but let me go into a little more details. I'll write something important for you over here. Please pay attention. So, first of all, say there is a credit card company, and what is the credit card company doing? It is granting credit to whom? To the card holders. Okay, it is granting credit to the card holders. So now here we have card holders. Okay, now card holders are going to make payments. Payments in the form of number 1, charges, interest, and number 3 could be repayment of principal. So these payments they are going to make to the credit card company. Okay, now this credit card company has basically the right to receive these payments, and we will say such rights become what? Credit card asset pool. Such rights become the credit card asset pool. Now what can be done? If there is an SPE, okay, buys this pool, and then this SPE issues ABS, then such ABS will become the credit card ABS. Such ABS will become the credit card ABS. Look at this structure to basically understand what exactly are the credit card ABS, and I'm sure it will give you clarity to understand what exactly credit card ABS stand for. Alright friends, once you have noted down this whole thing, what we can identify, it may not necessarily be this kind of structure which can be identified as an asset pool. Any receivable, so for example here there was a receivable which eventually became an asset pool, correct? The rights to receive these payments, it became the credit card asset pool. If it was not credit card payment but say royalty payment, then the right to receive that payment will become the royalty pool. It was a copyright pool, then the right to receive that will become a copyright pool, whatever. But some kind of asset pool can, an asset pool basically means there are certain rights to receive certain payments. Okay, ultimately what is happening, there will be some kind of asset pool at the backing of which the SPE will be issuing the credit card. So like earlier discussion, it is a credit card company in whose balance sheet these receivables will be there, but now SPE has bought these receivables from the credit card company. So now this credit card asset pool becomes a risk of the SPE and not the credit card company, correct? So these are very risky asset because they are unsecured completely, but being unsecured, the rate of interest charged on this credit card asset pool is substantially higher. Okay, so now when you are issuing this ABS, suppose this ABS is having a 10-year period and the first 5 years is declared as a non-amortization period and later 5 years is declared as amortization period. So what this SPE is going to do, it will receive the payments in the form of interest, charges and some principal repayments. Okay, all these will be utilized only and only for making coupon payments on its credit card ABS, only the coupon payments for the first 5 years. In my example it is 5 and 5. Okay, so first 5 years non-amortization period, the later 5 years it is amortization period. Now during the later 5 years, whatever payments are received from here will not be just utilized to make the interest payments to this ABS, even part principal will be repaid. That means the next 5 years will be the repayment period along with the interest. So that is the amortization structure. So if 10 year is the total length or the total maturity of this ABS, initial 5 years we have taken in our example as non-amortization period, later 5 years could be amortization period. So it is in the later 5 years that the amortization will become. Now what happens, suppose successfully SPE has repaid this entire credit card ABS and it has generated good level of interest income from this credit card asset pool, whereas paid substantially low interest to this ABS investor and earned a good profit margin. Once this 10-year round is over, it can again approach to the credit card company and demand for a few or demand for a new arrangement, and again this kind of chain can continue. But this is basically a very high risky asset class. But if I now get back to your notes, what we were reading, the quality of the credit card pool starts falling. So if that happens, like if that too many people stop paying, then the provision gets triggered. Which provision gets triggered? Something called early amortization, also known as rapid amortization. That means in this span, when we were talking about the non-amortization period, but during that period, suppose the credit card holders start making defaults in their payment, they are not making their monthly payment or they are not making payment at time, whatever be the minimum payment as made in their credit card invoice of that month, if they make default, 1 or 2 people making default, it's understandable, that will happen always. But substantial number of card holders, if they start making default, then SPE will come under risk. So SPE should make sure that it is repaying all its ABS earlier than their maturity. That means the rapid amortization, or you can call it accelerated amortization, or you can also call it early amortization, start happening, because otherwise in that whole structure it is SPE which will lose its credit worthiness, because it has issued the ABS at the backing of these credit card receivables, and if there are substantial defaults, it is SPE, to maintain its reputation, it will have to make sure that it is paying back all its credit card investors, I mean the credit card ABS investors. So that was all about the credit card matter. Now let us switch into the next point of discussion, that is all about solar ABS. Solar ABS are backed by loans to homeowners who borrow money to install solar energy systems on their rooftops. These loans help families to reduce their long-term energy bills, and the ABS structure allows solar finance companies to raise upfront funds from the investors by securitizing these future loan payments. These ABS have strong appeal from ESG focused investors. By investing in solar ABS, they are indirectly supporting renewable energy and environmental sustainability, which aligns with the global climate goals. The solar loans can be secured either on the solar equipment itself or on the home as a junior mortgage, offering an added layer of the security to ABS investors. Borrowers are usually credit-worthy individuals, and because they save on energy bills after installation, the risk of default is expected to be low. However, solar ABS is still a relatively new asset class, meaning it hasn't yet gone through a full credit cycle. Investors need to be aware that long-term behavior is still uncertain. One unique feature in many solar ABSs is the pre-funding period. After the ABS is issued and capital is raised, the trust is allowed a limited time window to invest in additional solar loans. This helps build a larger and more diversified pool of loans, which improves risk management and returns consistency. As with the other ABSs, internal credit enhancements such as over-collateralization, excess spread and subordination are commonly used to provide a buffer against credit losses. So now the point is, what exactly do we follow from this whole thing? So let me explain this to you again in a defined structure over here. The way I have explained you the credit card asset pool. Here we are taking the example of a solar power panel, that is a solar power equipment which a solar company, that is solar power company, is selling. So we have a solar power equipment company. It is selling solar power panels to customers. Now there will be certain set of customers who will be buying solar power panels by making upfront payment, no finance needed, correct? In that case, the customers are making the full payment to the solar power equipment company. But what if some customers are not having enough money in their account immediately to fund this equipment? They are looking for some kind of finance facility. Now comes a finance company in the scene. Finance company coming in the scene. finance company, maybe some agent from that finance company sitting along with the the salesman at the solar power equipment company, or the salesman can itself pitch that okay fine, you don't want to buy it by making upfront payment, we have a finance facility available. So the finance company now comes in picture and offers solar equipment loan to the customer. So now solar power equipment company has sold the panel to customer. So this company is now moving out of the scene, correct? This company is moving out of the scene. Now the arrangement is between the finance company and the customers, where customers have borrowed money from this finance company. What this finance company will do, this loan will be having the backing of it will be secured by what? Secured by what? Solar power panels, which are bought by customers. The loan will be secured by that. So loan is typically secured. Now the finance company will create multiple loans to various customers, and this becomes the asset pool now. If this is becoming the asset pool, what happens? This asset pool will become the backing, and this asset pool is owned by the finance company, but the finance company will sell. So the finance company will sell the asset pool to SPE, and SPE will issue ABS. I'm sure you are understanding this whole arrangement, right? So these ABS, which we are highlighting over here as the solar ABS, the investors of these ABS who are buying this ABS, the investors of these ABS, what they have as notion in their mind when they are investing into this, it is not just an investment made to earn returns. It is basically an investment made for even a global cause, where a renewable energy source like a solar power panel, ultimately we are investing into facilitating the buyers to buy such equipments, where the dependency on that solar power panel will remove their expenditures, which are recurring expenditures to purchase the power. That money which is saved can be utilized to pay off the loans, correct? So basically, imagine a customer who is regularly paying their electricity bills. Instead of paying electricity bills, that money which is saved on monthly basis, instead of paying to the electricity supply company, now they have electricity supply coming naturally from the solar power panel which is installed in their rooftop. So the money which is saved on month basis towards the electricity bills can be now utilized to pay off the loans of this solar equipment loan along with interest. That becomes the payment obligation by that customer who is buying the solar power panel. and the right to receive that money is becoming the asset pool. So basically this is a new concept in the field of finance. It is so new that right now even one round of the whole funding has not yet completed. When it started till now, it is not yet completed. That is the the reason we will say that this is a very new instrument coming into picture, new instrument in the market in the field of finance. So let me just help you to write up this whole thing in case you want to, or you may alternatively take the screenshot of the same. Alright, then once you have taken the screenshot, let me get back to our main sheet of notes. Alright, so we move ahead and we start discussing the next important feature, that is collateralized debt obligations, CDOs. A collateralized debt obligation, CDO, is a structured financial product issued by a special purpose entity, that is SPE. The CDO raises money by issuing bonds to investors, and in return it invests that money in a pool of debt instruments such as bond, loans or credit derivatives. The income from this pool is used to pay the investors. Unlike traditional APS like credit card or mortgage ABSs, which are backed by static pools, CDOs are usually actively managed. This means the collateral manager inside the CDO keeps buying and selling the assets in the debt pool to meet the cash flow and performance goals. This dynamic feature is a key characteristic of CDOs. So first of all, let me explain what exactly are CDOs, collateralized debt obligations. So this is again a new category of ABS. What is happening over here? If you see the process, it's a financial product issued by SPE. So SPE is issuing bonds, investors are buying these bonds, that is fine. CDO is raising money by issuing bonds to investors, and it invests that money in a pool just like any ABS, but that pool is not a pool of car loans or pool of mortgage loans or pool of credit card receivables. It is a pool of debt instruments. That means the pool itself is a pool of financial instruments, which could be bonds, loans or credit derivatives. Now over here, credit derivatives is another area which I have recorded in the other lecture, titled as credit default swaps. Basically this is an important feature at CA final exam and even CFA Level 2 exam, credit default swaps. So credit derivative, if you want to understand what exactly are credit derivative, the best thing is to understand about the credit default swap. So that kind of arrangement, along with bonds and loans which are marketable instruments, that all form an asset pool. So basically it will be so appropriate to identify that this time the asset pool is the portfolio of debt instruments. So I would want you to mark this point very well, that here the asset pool is representing nothing but the portfolio of debt instruments, and the whole pool is so dynamic that the income from this pool is used to pay the investors of the ABS. So let me take the matter ahead in the discussion. Unlike traditional ABS like credit card or mortgage ABS, which are backed by static pools, CDOs are usually actively managed, and the obvious reason I told you already, these itself represent a portfolio of debt instruments. This means the collateral manager inside the CDOs keeps buying and selling assets. You are just managing a portfolio, that is why you are continually buying and selling assets in the debt pool to meet the cash flow and performance goals. This dynamic feature is the key characteristic of CDOs. Now, types of CDOs based on collateral. Depending on what kind of debt instruments the CDO holds, it is given a specific name. If the CDO holds a pool of corporate bonds or emerging market debt, it is called a collateralized bond obligation, that is CBO. If it is backed by a portfolio of leveraged bank loans, it is referred to as collateralized loan obligation, that is CLO. So we can say CBO or CLO are the categories of CDO. Today CLOs are most common type of CDOs, especially after 2007 to 2009 global financial crisis, which led to tighter rules and simpler structures. Moving forward, subordination and tranching in CDOs. Just like ABS, CDOs issue multiple tranches of bonds, and I don't have to explain you all this. You have already understood what are senior tranches and junior tranches. Senior tranches receive the safest payments and have highest credit ratings. Junior tranches, which are also considered as equity or subordinate tranches, absorb loss first and therefore earn higher rate to compensate for the risk. One goal of structuring CDO is to make sure the lowest ranking tranche, that is equity, still earns attractive return after meeting the promised yields of senior tranches. This careful layering of return is what makes CDO structuring both as an art and science. So now we have types of CLOs, that is collateralized loan obligations. CLOs are kind of CDOs backed by leveraged loans, typically loans to or loans given to companies with weaker credit ratings but strong cash flows. There are three types: cash flow CLOs, market value CLOs, and synthetic CLOs. What are cash flow CLOs? These use the interest and principal payments from the loan portfolio to pay investors. This is the most common type. What are market value CLOs? These depend on the trading value of the loan assets in the market. If the manager can sell assets at a profit, payments are made from that gain. And what are synthetic CLOs? These do not actually hold loans but gain exposure from them through credit derivatives such as credit default swaps. I already spoke about this. So the CLO doesn't own asset but still takes on the risk. So here we are talking about the three categories of CLOs. If I have to mark a difference among these three categories for you to have a very clear understanding, I would say that cash flow CLOs are basically such instruments where the cash flow is coming from the interest on that loan. On the other side, the market value CLOs is a little different thing. Over there the gain is made on what? See, when an asset pool is sold by a finance company to SPE, that means an asset is being sold to someone. If you are selling an asset at a price which is higher than its current book value, obviously it is going to result into profit. So in that case, the entire pool of asset is being bought and sold in the market. So the market value of that asset pool becomes the point of identifying gain or loss arising on such sale. And yet third category, that is synthetic CLOs, here the asset pool does not indicate the right to receive cash flows. In fact, these are credit derivatives where without owning the asset you are having exposure to that asset. Now in case you have no idea about what are credit default swaps or what are credit derivatives, I will highly recommend to you that please watch my video on credit default swap. It will give you a complete clarity of what could be synthetic CLOs. Now the later part is again quite very simple. Investor protection in CLOs, that is built-in safeguards. So to protect investors in CLOs, several tests like different tests and rules are applied to the collateral pool. The cash flows from the loan must be sufficient to cover up the payments to CLO investors. What we call as over collateralization. So you have to make sure that whatever be the cash flow from the loan pools, it should be sufficient to pay off the CLO investors. Each tranche must meet a required level of over collateralization. So when you do go for over collateralization, it is not tranche wise, actually it is protecting all the tranches as a overall protection made for that entity. If breached, cash flows are redirected to fix the issue either by buying better loans or repaying senior tranches first. The loan portfolio must be diversified, meaning it can't be concentrated just on few sectors or borrowers. There are strict limits on low rated CCC and below, that is CCC is a type of low rated security. So CCC and below, there are strict limits on low rated debt on the pool to control excessive credit risk. These mechanisms ensure that CLOs can absorb stress and continue to save investors reliably. So that was the entire discussion we wanted to have on the topic ABS, that is asset backed securities. So in the next topic we are going to discuss everything about the MBS, that is mortgage backed securities.